Let's talk about a really fascinating part of the tax system. What if I told you that you could get money back from the government, even if you owe zero in taxes? It sounds a bit counterintuitive, but it's absolutely possible. And it's all thanks to something called refundable tax credits. Today, we're going to unpack exactly what these are and how they work.
So let's begin.
Here is our roadmap for this explainer. We'll start with the core concept. What actually makes a credit refundable? Then, we'll dive into 3 distinct practical examples, one for training, one for home renovation, and one for educators. And to finish, we'll pull it all together with a summary of the key takeaways. Okay, let's get right into it. Section 1. What exactly is a refundable credit? This is a fundamental concept, and once you grasp this, everything else we discuss today will fall neatly into place. So, let's break this definition down. A refundable tax credit is a special kind of credit that can be paid out to you, the taxpayer, even if the amount of the credit is more than the tax you owe. Most people think of tax credits as simply a discount on their tax bill, and for many credits that's true, but refundable credits go a step further. They aren't just a discount, they represent a potential payment directly to you. And this slide right here highlights that critical distinction. Let's think about a non-refundable credit first. They're valuable, of course, but they have a hard stop. They can only reduce your tax bill to zero and not a penny more. So imagine you owe $500 in taxes, but you qualify for a $700 non-refundable credit. Well, your tax bill goes to zero, which is great, but that extra $200 of credit, it just disappears into thin air. Now, contrast that with a refundable credit. In that exact same scenario, not only would your tax bill be zero, but you would get that extra $200 back from the government as a cash refund. That is a massive difference, and it's precisely why these credits are so powerful. Now, I just want to be very clear about where this information comes from. Our analysis is grounded directly in official tax guidance documents. We are not speculating here. We are going right to the source material to ensure everything is precise and up to date. Okay. Let's move on to our first real-world example. Section 2 is all about the Canada Training Credit. This is a fantastic case study in how tax policy can be used to encourage personal investment in skills and ongoing professional development. So the first question naturally is, who can actually claim this? As with most tax measures, there are specific rules. Let's dig into the eligibility criteria. All right, there are a few key elements here. First, there's an age bracket. You have to be between the ages of 26 and 65 at the end of the tax year. Now, the way this credit works is really interesting. Starting back in 2019, eligible individuals began to accumulate a notional balance of $250 each year. Think of it as a virtual savings account for training that the government tracks for you. Then, when you actually pay for eligible tuition or other qualifying fees, you can claim 50% of those costs back as a refundable credit, right up to whatever balance you've accumulated over the years. Now, this accumulation doesn't go on forever, there is a ceiling. The total cumulative lifetime limit for the Canada Training Credit is $5,000. So, over the course of your working life, this provides a really substantial incentive to continue upgrading your skills and investing in your professional education. Let's pivot to our next example. Section 3 covers the multigenerational home renovation credit. This is a relatively new credit, and it really speaks to a growing societal trend: families adapting their homes to support multiple generations living together. Okay, so you might be thinking, does my kitchen remodel count? Well, probably not. The rules for this are very specific, which is what we'd expect for such a targeted credit. So, what kind of renovation actually qualifies? The requirements are quite precise. This isn't for just any home improvement project. It is specifically for constructing a secondary unit for a qualifying relative. That's a senior who is 65 or older, or an adult who is eligible for the disability tax credit. And that term secondary unit is key. It has to be a self-contained dwelling. We're talking about a space with its own private entrance, kitchen, bathroom, and sleeping area. If your project meets all those criteria, the credit you can claim is 15% of your eligible costs. And again, just like the training credit, there's a maximum here. The government has capped the qualifying renovation costs at $50,000. It is important to note that this is the cap on the expenses you can claim, not on the credit itself. The credit is then calculated based on this number. Let's make this real with a quick example. Let's say a family decides to build an in-law suite for an aging parent. They spend exactly $50,000 on the project, and it meets all the qualifications for a secondary unit. So what happens at tax time? Well, they can claim 15% of those costs. The math is simple. 15% of $50,000 is $7,500. And because this is a refundable credit, that $7,500 can come back to them as a direct refund, which is a huge help in offsetting the cost of a major renovation. All right, for our third and final case study, we're looking at something on a different scale, but one that's equally important, the eligible educator credit. This credit is all about recognizing and reimbursing some of the common out-of-pocket expenses that teachers and educators incur. As with any tax credit, the definitions are everything. So, two questions come to mind immediately. Who qualifies as an eligible educator, and what exactly counts as an eligible supply? Okay, let's look at the key details. An eligible educator is generally a teacher or an early childhood educator who holds a recognized certificate. Now, the supplies, this is interesting. It covers the things you'd expect, right? Consumable supplies like paper, glue, and posters. But it can also cover durable goods, things like laptops, tablets, or webcams, with one really important condition. These must be items that were not provided or reimbursed by the employer. The credit itself is then calculated as 25% of the cost of these supplies. Now, there is an annual cap on the expenses you can claim. You can claim up to $1,000 worth of eligible supplies each year. So even if an educator spends, say, $1,500 out of pocket, the credit will only be calculated on that first $1,000 of expenses. So let's see how this works in practice. It's very straightforward. An eligible teacher spends the maximum claimable amount, $1,000, on supplies for their classroom. The credit is 25% of that cost, so they receive a $250 refundable credit. It's a direct acknowledgement of the personal funds that educators often put into their classrooms. Okay, we have covered a lot of ground, so let's bring it all together in our final section, a summary and a comparative look at the key takeaways. This table gives us a great side-by-side comparison. First, you have the Canada Training Credit, focused on professional development with a $5,000 lifetime benefit. Then there's the multigenerational home renovation credit, a much larger scale project aimed at family living, with a potential benefit of $7,500. And finally, the eligible educator credit, a smaller annual credit for school supplies, maxing out at $250. You can see they all target very different activities and policy goals, but they're all built on that same foundational principle of refundability. And that brings us to the single most important takeaway from our entire discussion. This is the crucial point. Refundable credits can provide a direct financial benefit regardless of your tax liability. It doesn't matter if you owe a lot of tax, a little tax, or no tax at all. These credits can result in a net payment to you from the government. So I'll leave you with a question to consider for your own financial situation. Now that you understand the underlying principle of how these powerful credits work, what other credits might be out there that apply to you? The tax system is certainly complex, but understanding concepts like this can make a very real financial difference. It's something that is absolutely worth investigating.